Safety Manager, From Zero to Expert by Dmitry Borovoy. Insurance. Chapter 10. Insurance, one of the most expensive topics in a carrier's life, and one of the least obvious. This chapter covers the 5 big policies. MCS 90, what goes into the price of a policy, how to renew without a gap, what happens when we forgot to add the truck, and how to read a certificate of liability like you've been doing it for 10 years. After this chapter, a call from your insurance agent stops being a stressful event. 10.1. Why nothing works without insurance. Insurance in the trucking business isn't an accessory. It's your ticket in. Without an active policy, FMCSA won't grant you authority. Without a COI in hand, no legitimate broker will give you a load. The entire industry sits on this foundation, and there's no way around it. Where does the strictness come from? Short history. Before the 1980s, trucking was a closed club. After deregulation in 1980, the barrier to entry collapsed, the number of carriers exploded, and so did the crashes. Accident victims often walked away with nothing. The at-fault party had no policy and no money. Congress answered with federal minimum limits, in force since January 1, 1985, 49 CFR Part 387. $750,000, general freight. $1 million, oil and certain hazardous materials. A car hauler legally falls under general freight at $750,000. But the market and brokers demand $1 million from auto transporters, so the effective minimum is the same. $5 million, heavy HazMat, bulk chemicals, poison gases, certain high-risk categories. That's the legal floor. The market set the bar higher. $1 million auto liability plus $100K cargo is the minimum brokers will even talk to you at. Pause. The numbers in this chapter sound brutal. $1,500 a month per truck, $2,500 deductibles, tens of thousands in deposits. The first time through, you want to close the book and walk away. Don't. Here's what doesn't get said out loud. Insurance is the most manageable expense in your company. You can't make fuel cheaper. You can't make your ELD work 20% better. But insurance, you can move. By 30–50%, and I mean that literally, not figuratively. Clean MVRs, zero claims, payments on time, and the agent calls you with offers. Discipline and safety converts to money, dollar for dollar. Who the policy actually protects? Get this clear up front, because it changes how you think about it. 1. You. So when you collide with someone's Lexus, you're not pulling $250,000 out of a drawer. 2. The shipper and broker, their freight is covered, they sleep at night, they keep giving you work. 3. A third party, a pedestrian, an oncoming driver, the owner of a fence. No place in this industry. That's it. 10.2. MCS 90, what a safety manager must understand. When people say carrier insurance, they don't just mean the policy itself. They also mean the MCS 90 endorsement. This is a federal add-on that registers your insurance with FMCSA. MCS 90, Motor Carrier Endorsement for Motor Carriers of Property, guarantees one thing. Even if a loss formally falls outside coverage, for example, your driver was hauling something not listed in the policy, the insurer still pays the injured third party up to the federal minimum, $750K, $1 million, $5 million. It's essentially a public pledge by the insurer that you, as a carrier, are financially sound. Here's what you need to know as a safety manager. No MCS 90, no authority. The agent files it electronically with FMCSA. BMC 91 or BMC 91X, the forms the insurer uses to confirm financial responsibility to FMCSA. BMC 34 or BMC 83, same thing but for cargo liability. Federal minimum for household goods is $5,000. BMC 35, the cancellation form. The insurer must notify FMCSA 30 days in advance. The moment this form is filed, your authority freezes automatically unless you submit a new policy in time. Memorize BMC 35. That's the paper you never want to see in your life. 10.3. The 5 big policies, the map. There are dozens of product names, but the structure is simple. 5 big policies. Everything else is a variation or add-on. 1. Auto liability, primary liability, the main one, mandatory, covers damage your driver causes to someone else's property and health. Federal minimum for general freight, $750,000. Market standard, $1 million. HazMat, $1 million for most loads, $5 million for the high-risk categories under Section 387.9. This is the policy MCS 90 attaches to. 2. Cargo insurance. Covers the freight you're hauling. Burned, stolen, soaked, smashed. Cargo pays. Federal minimum for household goods is $5,000. Pocket change, irrelevant. Market standard, $100,000 for dry freight. For reefers, you need refrigeration breakdown, coverage for reefer unit failure, and the spoiled load that results. Ice cream melted, dairy soured. Technically not required by law for general freight. In practice, no broker gives you loads without it, which means it's required. 3. Physical damage. Your own iron, the truck and trailer. 2 parts. Collision, impact in a crash. Comprehensive everything else. Theft, fire, hail, vandalism, tree on the cab, flood. Not legally required, but if the truck is leased or financed, the bank will require physical damage. No financing otherwise. An old truck bought cash, you can skip it and save. 4. General liability. Coverage for the company's office. The premises, the building, anything not tied to the truck moving. A courier slips on your front step. A visitor to the office hits their head. Your guard dog bites someone. Usually $1 million limit, $500 to $1,500 a year. Cheap, but serious brokers ask for it. 5. Non-trucking liability, bobtail. A subtle one. While the truck is under dispatch, heading to pick up a load or hauling one, the company's auto liability covers it. The moment the driver on his day off drives that same truck to Walmart for groceries, he's off duty, and primary insurance doesn't apply. For those situations, non-trucking liability, coverage off dispatch. Truck without trailer. Especially relevant for owner-operators running under someone else's authority who use the truck personally. Additional coverages, don't memorize these, just recognize them in contract text. Coverage, what it does. Trailer interchange. Someone else's trailer you're pulling, drop and hook. On hook, for tow trucks, covers the towed vehicle. Motor truck general liability. General liability specific to trucking operations. Limited depreciation. Closes the gap between market value and lease balance. Mechanical breakdown. Covers breakdown repairs. Downtime. Compensation while you're down for repairs after a crash. Rental reimbursement. Pays for a rental truck while yours is being fixed. Passenger accident. If there's a co-driver in the cab and they get hurt. 10.4. Drivers, workers' comp, or occupational accident. There's a fine line here, and I want you to see it clearly. Confusion on this question has cost companies more money than any other safety mistake. Workers' compensation. Workers' comp is a legally regulated insurance, mandatory in almost every state for companies with W-2 employees. It covers medical treatment for on-the-job injuries, lost wages during recovery, rehabilitation, death benefits to the family. Key points. The rate depends on business class and experience rating, your incident history. More accidents, more expensive policy. Texas is the only state where a private employer can legally opt out of workers' comp. Oklahoma's opt-out was struck down by the state Supreme Court in 2016. By accepting workers' comp, the employee gives up the right to sue the employer for bodily injury. Trade-offs both ways. Occupational accident insurance. Occupational accident is the alternative for independent contractors, 1099 owner-operators. Why companies choose it? 2 to 3 times cheaper than workers' comp. $125 to $175 per month versus $400 to $600. Driver stays on 1099, handles their own taxes. Company avoids workers' comp audits. Typical benefits package. Accidental death, $250,000. First payment $25K, then 1% per month for 10 years. Accidental medical expenses, up to $1 million. Disability, weekly payments as wage replacement. Deductible, usually $100 per incident. What to choose? For owners, if you've got 1 to 3 owner-operators on 1099, go with occupational accident. Cheaper, cleaner, no workers' comp audit. If you've got company drivers on W-2, workers' comp is mandatory, with TX as the only exception. For staff safety managers, employed safety, your first job is to check whether the company has either of these at all. In my experience, more than half of small carriers have neither. That's a live mine. The scenario after which people stop cutting corners. Ivan is 3 weeks into working as an owner-operator. On a Saturday, he takes the truck for a personal errand, slips in a parking lot, breaks his hip. A month later, a $180,000 claim hits. Medical plus lost income. The company has neither workers' comp nor occupational accident. The owner pays out of pocket, sells the second truck, and the company closes. Occupational accident would have cost $150 a month, $1,800 a year versus $180,000 on your head. That's the entire difference. What to do if you're scared? You're the safety manager at a company with neither workers' comp nor occupational accident. You're reading this and realizing you're sitting on a bomb. Take 3 steps today. First, send the owner a written message, email, not voice. Lay out the risk and recommend opening coverage. That paper protects you personally if something happens. Second, request quotes from 2 or 3 agencies on occupational accident. When the owner sees $125 to $175 per driver, resistance usually ends. Third, if he still refuses, save the correspondence. If this ever hits court, the question, "Did the safety manager know?" will come up, and you'll have an answer. Knew, warned, owner decided. Trucks and trailers, how to add them and why on time. How adding a truck works. Every active truck must be added, endorsed to the policy. Steps. 1. Truck arrives. Send the agent registration, VIN, year, make, model. 2. Agent adds the unit to the list. 3. Agent sends back an auto ID card, the paper with policy number, dates, VIN. This is proof of insurance. Agent sends an updated current unit list, the full list of trucks on the policy. Deductible when adding a new truck is usually $2,000 to $3,000. That's the number that makes owners play "let's wait and see if the driver sticks around." It's the most expensive game in the industry. The truck that didn't get added. Typical scenario, and I've seen it in dozens of variations. An owner-operator shows up with his truck. The owner tells the safety manager, "Don't add him to insurance yet. Let's wait a couple weeks. I don't want to burn a deductible for nothing." A week later, the driver backs into somebody's fence. Small damage, $3,000 maybe. The safety manager panics, emails the agent, backdates the truck and driver onto the policy, opens a claim. The fence owner turns out not to be the agreeable type. He goes straight to the insurer. 2 weeks later, a letter. "We checked FMCSA records. There's a DOT inspection on this VIN from 2 months ago. Your dates don't match. Policy canceled." 2 scenarios from here. Rare one, you manage to talk the agent into keeping the policy on the strength of the relationship. Normal one, cancel, entry in the shared insurance database, renewal 30 to 50% higher, half the insurers won't touch the company anymore. Rule, no exceptions. New truck, new driver equals on the policy the same day. A $2,500 deductible isn't money. A canceled policy and lost authority is money. Trailers, their own special hell. In any company larger than 10 trucks, trailers are a headache. They get lost, swap between carriers, sit on someone else's yard, get sold without being logged. What to keep in mind. Trailers also go on the policy, usually physical damage plus cargo. Cheaper to cover than a truck. 100% of trailers on the policy. Realistic minimum 80%. Anything below that is a mine. Reconcile quarterly. Company list versus policy list. Close any gaps immediately. Checklist. New unit addition checklist. Registration with VIN, year, make, model received. Email to agent. Please add unit, VIN with attachment. Coverage type specified. Auto liability, cargo, physical. Auto ID card and updated current unit list received. Auto ID uploaded to the unit file. See Chapter 6. Unit entered in internal records with date added. Copy of auto ID handed to the driver. Kept in the cab. 10.6. What drives the price? 6 factors. A new owner hears $1,500 a month for one truck and grabs his head. Let's break down where the number comes from and what you can actually move. 1. State of domicile. State economy, taxes, carrier density, accident statistics all matter. Expensive, NJ, NY, CA, FL. Cheap, SDWI, MT, IA. 2. Coverage limits. Federal minimum $750K is the floor. The market wants $1 million. Premium brokers often want $2 million. Higher limit equals higher premium, but without the right limit, you don't get loads, and there's nothing to discuss. 3. Cargo type. General freight, base rate. 10 to 15% the unit breaks down. Car hauling, more expensive, cargo value. HazMat, 2 to 3 times everything else. Hiding the cargo type from the agent is a one-way road. When a claim hits, the insurer denies on material misrepresentation, and you're alone with the injured party. 4. Radius. Local under 100 miles, cheapest. Regional under 500 miles, mid-range. Long haul OTR over 500 miles, most expensive. Intrastate, inside one state, is cheaper than interstate across the country. 5. Truck age and type. New trucks cost more, repairs and replacement are more expensive. Very old trucks, 10 plus years, either don't get insured or carry a bumped up deductible. 6. Driver and company history, the most manageable factor. They look at driver MVRs, tickets and accidents over 3 years. Experience, CDL under 2 years equals plus 30% premium. Loss runs, your claims history over 3 to 5 years. CSA scores, bad numbers equals expensive policy. Tickets, every speeding ticket adds to the price. Market benchmarks, 2024-2025. Small, 1 to 3 trucks, general freight, no history, $800 to $1,200 a month per truck. Midsize, 5 to 10 trucks, reefer, clean history, $1,000 to $1,500 a month per truck. New entrant with no history, first year plus 20 to 40% premium. Company with a string of claims, $2,000 to $2,500 a month per truck and up. 10.7. Certificate of Liability Insurance, how to read it. One of the most common questions. A broker asked for a COI. What is that and what should be on it? Certificate of Liability Insurance, COI, is a one-page certificate the agent issues to brokers and shippers as proof of active coverage. 1. Date of issue, when it was issued. 2. Producer, the insurance broker who placed the policy. 3. Insured, your company name must match your MCDOT name exactly, letter for letter. 4. Insurers, who's carrying the risk. 5. Coverages, commercial general liability, usually $1 million per occurrence, $2 million aggregate. Automobile liability, $1 million combined single limit, CSL. Cargo, $100K, with refrigeration breakdown noted if reefer. Hired autos, non-owned autos, notation about rented trucks. 6. Policy numbers, separate for each coverage. In a crash, the policy number is the first thing you give the other side. 7. Effective date, expiration date, when it starts and ends. Expiration is the single most important date on your calendar. 8. Certificate holder, who the certificate was issued to, a specific broker or shipper. Practical points. Every broker wants their own COI with their name in the certificate holder box. The agent usually keeps a general COI and customizes on request. New broker shows up, you email the agent. The certificate comes back the same day. Always look at the COI before sending it out. Is it current? Are the limits right? Is the name right? 10.8. Renewal without a gap. Policies are usually annual. When the year ends, 3 scenarios. 1. Renew with the current agent, easiest. 2. Switch agents, takes longer, sometimes cheaper. 3. Allow a gap, catastrophe. Detail below what a gap is and why it kills companies. Old policy ends on the 1st, new policy starts on the 5th. 4 days of gap between them. Here's what happens. Insurer files BNC 35 with FMCSA. FMCSA puts your authority into out of service. Physically, you can't haul for those 4 days. Every load in that window is illegal. At next renewal, insurers see the gap and jack the price 30 to 50%. Some won't write you at all. Brokers see the cancellation history and walk. Gaps are not acceptable, not negotiable. Step-by-step renewal. 60 days before expiration. Reminder from agent received. Usually arrives on its own. Decision: renew here or shop. 45 days out. If shopping, send requests to 2 to 3 agencies. Document package for quotes. Loss run reports separately for auto liability, cargo, general liability. MVRs on active drivers, fresh, less than 30 days old. IFTA reports for 4 quarters, show mileage and operational pattern. List of units, all trucks and trailers with VINs. List of drivers, names, CDL, hire dates, MC DOT numbers. 30 days out. Proposal, quote, from agent, check, total annual premium, down payment, usually 20 to 25% of annual premium, deductibles, limits on each coverage, prohibited items, what isn't covered, prohibited drivers, who won't be accepted because of MVR. Compare offers not on price, but on price plus coverage. 15 days out. Contract signed. Down payment made. New COI and new auto ID cards received. Drivers get fresh copies in their cabs. Renewal day. New policy active at 000, the day the old one expires. FMCSA has received the new BMC 91. Checklist. Golden rule of renewal. New policy starts at 001 of the day the old one ends at 2359. Gap equals 0 seconds. Not minutes, not hours, seconds. Why the renewal price went up? 4 reasons. Late payments. Payments last year ran late. You're a risky customer. Claims. Any open claim lifts the rate, even when you weren't at fault. Tickets and violations on drivers. Everyone hits the MVR. General market movement. Commercial insurance in the U.S. goes up 5 to 10% a year on its own. Medical costs up, jury verdicts up, repair costs up. Points 1, 2, 3 are in your hands. Point 4 isn't. That's the market. Focus on what you control. Checklist. Checklist. Safety manager brings insurance down. Payments always a couple days before the deadline, not at the wire. Hire only drivers with clean MVRs for 3 years. Safety meetings every month. Pull MVRs at least annually, Chapter 5. Pre-trip and post-trip mandatory, DVIRs closed, Chapter 6. ELDs on every truck, HOS violations near 0, Chapter 7. Dual view dashcam, road plus cab. Preventive maintenance on schedule, Chapter 6. 10.9. 3 scenarios. Ideal, normal, blow-up. For staff safety managers. Ideal, 3-truck company. Owner runs tight. Every truck on the policy the day it goes out. Clean MVRs. Occupational accident on all owner-operators. No workers' comp needed. 0 claims for the year. At renewal, premium drops 8%. Brokers see the history and send the best loads. Normal, 7 trucks. 1 small claim. Somebody bumped another vehicle in a lot. $4,000 damage. 1 speeding ticket. Renewal plus 12%, within normal range. Owner frowns, but the company runs. Blow up. 4 trucks. A new owner-operator didn't get added to the policy in time. Crash. Tried to backdate coverage. Insurer caught it. Policy canceled. Scramble for a new insurer. 6-day authority gap. 2 regular brokers gone. New policy plus 45%. Had to sell a truck to fill the hole. The lesson is simple. Insurance discipline costs $0 and saves tens of thousands. Key takeaway. Chapter 10 Takeaway 1. Insurance is your ticket in, not an option. No active policy and MCS 90, no authority. 2. Federal minimums, $750K, $1 million, $5 million by cargo type. Market demands $1 million auto plus $100K cargo. 3. The Big 5. Auto liability, cargo, physical damage, general liability, non-trucking liability. 4. Drivers, workers' comp W-2 or occupational accident 1099. Without one of these, there's a bomb under the company. 5. New truck and new driver go on the policy the same day. Saving a $2,500 deductible turns into a canceled policy and lost authority. I've seen this road. 6. 6 price factors. State, limits, cargo type, radius, truck age, history. The one you control is your history. 7. Renewal without a gap. Old ends at 2359, new starts at 000. Documents ready 45-60 days out. 8. Loss run plus MVR plus IFTA. No renewal happens without these 3 packages. You've got Chapter 10, if. You can explain the difference between auto liability and general liability. You understand what the MCS 90 endorsement is and why FMCSA needs it. You see the difference between workers' comp and occupational accident and know when to use which. You can read a COI and find the policy number, limits, expiration date. You know the 6 price factors and which ones are in your hands. You understand what a gap is and why you can't allow one. You can list the documents needed for renewal. New truck, driver, on the policy same day is automatic for you. You understand what a loss run is and how it affects renewal. Insurance is where new owners lose the most money. 3 typical mistakes that cost thousands. 1. Taking the first offer without requesting alternatives. 2. Putting off adding trucks and drivers. Losing the policy, renewal 50% higher. 3. Allowing a gap between agents, authority freezes. Trucker Navi works with a pool of insurance partners. Progressive Smart Haul, Coverwell, Byberk. 3. We match a policy to your situation, cargo, company age, geography, fleet size, and run renewals without a single second of gap. Bonus. Clients on Trucker Navi's ELD get up to $2,000 off the annual policy from insurance partners. Credit for documented HOS discipline and low fleet crash rates. Call us at 315-871-0833 or WhatsApp +1 929 347 4410 or visit truckernavi.com or email data@truckernavi.com. Offices NY, NJ, FL. That was a chapter from Safety Manager from Zero to Expert by Dmitry Borovoy, founder of Trucker Navi. The full book is on Amazon. The companion page is at truckernavi.com/en/book.